Welcome to the condensed version of the daily update, where I'll go over the action in the market for Friday, July 7th, and then we'll see how things look for Monday, July 10th. The reason for this video is to make it shorter, since I know a lot of you are busy, and just pull out the different bullet points that I talk about and different charts that we're looking at. If you want a more in-depth discussion of what's actually happening in the market, please switch over and look at the full-length daily video update. Now, on Friday, we looked to be doing better at the beginning. We had a solid open, we were moving higher, but then we hit some upper resistance and spent the rest of the day coming back down, and we ended up finishing negative. We're kind of right in between. We're still looking positive, but if we see more follow-through selling and more weakness, that's going to switch us over to a negative environment. So let's go back and talk about what happened. The mega cap weakness did drag down the S&P. The mega caps have really been helping the S&P a lot in 2023. Well, some folks decided to go in and start taking some profits. That pulled those prices down, which in turn pulled the indexes down. Value and small cap stocks did have a pretty good day, but we want to see growth stocks doing better. And since value outperformed growth, we didn't see a lot of improvement in some of our charts, but they're still hanging in there. On a short-term basis, we're still keeping an eye on the stochastics. Part of those different three charts that we look at are still extreme positive. On an intermediate term basis, our oscillators are looking toppy. They're starting to turn down just a little bit and turning a little bit more negative. But if we have some solid upward movement, that could shift things back looking more positive. We also have the Sean trend meter that's starting to get extreme positive. And believe it or not, we also have the Stoch RSI, which has already gone down, and we're extreme negative in oversold territory with that indicator. The dollar was down and interest rates were mixed on the day. It's been interest rates that have really been driving the market over the last few days. All of the yield curves that we watch are still inverted. Sentiment is still extreme. We're at 78 where we had been at 78. Our trend is still positive, but we're starting to drop below the moving average. The green line is coming down, even though it's still on top. But both the moving average and the ADX are still above 20. Our bias is negative, and our momentum is mixed to negative. The economic reports that came out, we had the non-farm payrolls. This is the biggest economic report of the month. That report came out at 209,000. They had expected it to be 220,000, so a little bit weaker than they thought. And it was also down from the 306,000 that we saw last time. Private payrolls came in a lot weaker than expected at 149,000, so they were up, but they had expected them to be up at 210,000, also down from the 259,000 we saw last time. The unemployment rate is at 3.6%. Last time it was at 3.7%. The average hourly earnings were up a little bit to 0.4%, where they expected it to drop to 0.3%, but instead it came out the same as last time, being up 0.4%. On a year-over-year basis, that equates to 4.4%. The average work week did tick up slightly to 34.4. They expected it to come in at 34.3. Last time it did come in at 34.3. Here's the intraday chart showing how we had a kind of a positive open. We came down to the daily pivot, went up off of that, came down to the daily pivot again. So we were able to establish some support, and then we started to go up higher. We got above R1. We never made it up to R2. We hit some resistance at about 44.40, and then the selling started to come in. We dropped down below R1. We dropped down below the unchanged level, the daily pivot, and closed at the low for the day. Here's another chart that we're watching. The VIX and the S&P 500 correlation. We're starting to get above the dashed line now. Now, this could still continue to go up higher. And most of the time, when this spikes and starts to come down, that is negative for the market, but sometimes it can also be positive. We're also watching the skew index. After almost getting to this extreme positive reading, it's starting to come back down now. So if it continues to fall, we'll stop focusing on this chart for right now. Here's our trend showing how the ADX is dropping. The green line is coming down. It turned up just slightly, but it is on top, so we still default to the positive trend. We're keeping an eye on the transports too. They showed some improvement on Friday. During the day, they were actually above this other high that we had set, but then settled back down a little bit. Can we continue to go up, or will we go sideways, or will we continue to go down? We can see on the bottom where the utilities did show some weakness. Here's the transports to S&P 500 ratio. In a good solid environment, we want to see this line continue to go up. Then we look at the relationship between the S&P and the transports, and their relationship is getting stronger. We're also keeping an eye on the NASDAQ at the 61.8% retracement level. We have not been able to break above that. We're below it right now. If we start to fall, will we go all the way down to this 50% retracement level or chop sideways for a while? We're also keeping an eye on this previous high in the NASDAQ 100. We came right up to this level a number of times now and have not been able to break through that. Interest rates have really been going up. We saw that on Wednesday and Thursday, and also a little bit of an increase on Friday. So what's our outlook for Monday? The technicals were still positive, and we are still in that stance overall, and so far support has held. But if we see some more weakness, especially if we start to break below support, we're going to turn things more negative. We have wholesale inventories coming out as well as consumer credit on Monday. Neither one of these are real market movers. We're keeping an eye on the geopolitical events. The markets are really fixated on inflation and interest rates, which are bleeding through into growth concerns. If the economy is going too slow, that kind of makes the market feel uneasy. If we're going too fast, that means the Fed will continue to raise interest rates. Here's the calendar for the upcoming week. One thing to note, we have CPI coming out on Wednesday, PPI on Thursday. And then the Stock Traders Almanac statistics for Monday, where we're neutral to positive with all three major indexes. We will be on the 5th trading day of the month, where we tend to be a little more sideways overall before we head into a choppy environment, and it's about the middle part of the month where we tend to see more weakness. Then we're keeping an eye on this for the NASDAQ as well, where it tends to perform well into the middle part of July. So our scenarios, hard to go with the down one right now. We're still positive overall with our technicals, but if we see more weakness, we're going to be switching more over to a negative stance. We're still leaning towards the up scenario, even though we need to break out and see a lot more strength than what we've been seeing. We're not going with the sideways trend right now because even though the ADX is below the moving average, it's still above 20 overall. Warning signs, the VIX continues to show complacency. It's acting kind of strange. That's why we're looking at that SPX to VIX correlation. The cumulative new highs and new lows for the NASDAQ still are showing weakness, and we're still above the level set back in 2007 with the 3-month yield, which happened right before we saw the great financial crisis. The S&P growth is starting to show weakness. It's still in an overall uptrend, but when compared to value, it's really starting to decline. Earnings season can either be positive or negative. The positive signs, we have seasonality and setups that still remain in the background. Our long-term daily chart for the special K is showing that we're more positive, where the weekly chart is still looking negative. The long-term equity put-call ratio is positive. That 253-period simple moving average continues to decline. The S&P remains above the downtrend channel upper line, and we're still in a risk-on posture. The transports are showing some improvement, but are they going to be able to break above that resistance that we're still below right now? Lower price levels so far have been providing support. The S&P is outperforming utilities, and we're watching the NASDAQ at that 61.8% fib retracement level, and we're watching the NASDAQ 100 at that previous high. They need to get above that and then close above those levels for things to turn more positive. The staples to S&P 500 ratio continues to decline, which often gives support to the S&P. The small cap index based on the Russell 2000, that has generated a recent golden cross, and the mid caps have also generated a recent golden cross. Small and mid cap growth continues to be positive. So our conclusion, the S&P remains positive, but it could turn more negative if we see more weakness, especially if we fall through support. On a short-term basis, we're still positive for right now, and we're no longer overbought. Intermediate term, we need to see more follow-through buying. In the long term, we still remain positive. Thank you. I hope you found this helpful. Please feel free to check out some of the other videos that I post. Have a great weekend, and I will talk to you in the next video.